Imagine this: you just received your salary, and you're feeling great about starting your investment journey. You've heard about mutual funds but feel a little lost about where to begin. Don't worry, in this video, we'll explore how to build the best mutual fund portfolio for long-term goals. I promise it's simpler than you think, and in the next 8 minutes, you'll walk away with clarity and confidence. Before we dive in, here's something super important. Always go for direct plans over regular plans when investing in mutual funds. Why? Direct plans have lower expense ratios because they skip the commission paid to brokers. The details of both plans are otherwise exactly the same, so why pay extra? Another tip: stick with funds that have been around for more than 5 years. Why? Funds with a longer track record often have experienced fund managers and tried and tested strategies. Newer funds carry higher risks of closure due to poor performance or low assets under management. Now, let me introduce you to 3 equity growth funds I've shortlisted for long-term goals. Parag Parikh FlexiCap Fund, HDFC Midcap Opportunities Fund, ICICI Prudential India Opportunities Fund. You might ask, why these funds? Well, all of them have consistently outperformed their benchmarks. As shown in the attached chart, their performance is impressive. But wait, don't rush to invest just yet. Let's analyze them step by step. First, let's talk about beta. Beta of the mutual fund measures how risky a fund is compared to its benchmark. A beta less than 1 means the fund is less volatile than the market. If the beta is 1, an investor might prefer an index fund over a managed fund, as the fund's performance mirrors the benchmark. However, if the beta greater than 1, the fund carries a higher risk than the benchmark itself. For our 3 funds, the betas are 0.71, 0.84, and 0.76, all less risky than their benchmarks. So far, so good. But remember, beta only tells you how a fund behaves relative to the market, not its actual risk. For that, we need to check the next ratio, that is alpha. Alpha measures how much extra return the fund generates compared to the benchmark, adjusted for risk. Think of it as the fund manager's scorecard. To calculate alpha, use this formula: fund return, risk-free rate, beta x, benchmark return, risk-free rate. Or you can get the ratio in websites platforms like Moneycontrol, Morningstar, etc. For our 3 funds, the alphas are all higher than their respective categories, which means they are doing a great job delivering extra returns. Now, let's talk about standard deviation, a common term for all as it measures how much the fund's returns fluctuate. Lower standard deviation means less volatility. For our selected funds, the standard deviations are lower compared to their categories, meaning these funds are relatively stable. But it doesn't end here. Let's take this into further analysis using the Sharpe Ratio. Sharpe Ratio measures the return you earn for every unit of risk you take. Let's break this down with an example. Imagine you have 2 mutual fund options, Fund A and Fund B. Fund A offers a return of 16% and 20%. If we only look at returns, Fund B might seem like the obvious choice. But what if we consider the risk involved? Fund A has a standard deviation of 12%, while Fund B has a much higher risk at 22%. Let's also factor in a risk-free rate of 6%, this could be Treasury bill. Using the Sharpe Ratio formula, Fund A gives 0.83 and Fund B gives 0.64. So, even though Fund B has a higher return, Fund A is the smarter choice when you consider the risk involved. For our funds, the Sharpe ratios are all better than their category averages. Simply put, these funds offer better risk-adjusted returns. Important note: Sharpe Ratio only considers price-based risk like volatility. It doesn't account for credit, default, or liquidity risks. So, use it primarily for equity funds, not debt funds. Next up, expense ratio. This is what you pay the fund manager to manage your investments. Even a small difference here can add up over the years. I've attached screenshots showing the impact of expense ratios on SIP investments. You'll also find links in the description to both SIP and lump sum investments. Calculate this yourself. Thankfully, all our selected funds have competitive expense ratios, which is great for long-term growth. Please note, if you withdraw funds within a year, you'll face an exit load. So, always align your investment with your long-term goals. Lastly, let's understand the capture ratios. Capture ratio tell us how much of the market's ups and downs a fund captures. This metric is crucial for market-linked funds, as it highlights how effectively a fund captures positive and negative benchmark returns over a given period, reflecting the market volatility. For the Parag Parikh FlexiCap Fund, the upside capture ratios over the selected periods are 90, 94, and 84, indicating the fund's ability to capture positive benchmark movements. Meanwhile, the downside capture ratios are 72, 55, and 45, showing how much of the negative benchmark movements the fund absorbed. Similarly, for the HDFC Midcap Opportunities Fund, the upside capture ratios over the same periods are 97, 95, and 96, reflecting strong participation in benchmark gains. The downside capture ratios, on the other hand, are 65, 81, and 85, illustrating the extent of negative benchmark movements captured by the fund. The ICICI Prudential India Opportunities Fund does not have sufficient investment history, so Morningstar hasn't provided its ratios. Ideally, the upside capture ratio should exceed 100, while the downside capture ratio should remain below 100. Upon review, the downside capture ratios for both funds perform well across all 3 time periods, staying under 100. However, the upside capture ratios fall short of expectations. Does this mean the fund is not worth investing in? Not necessarily. It's essential to ask, can a fund excel in both ratios simultaneously? In practice, a fund can usually optimize only one ratio effectively. Attempting to maintain both ratios perfectly often leads to a high turnover ratio, a less desirable trait in mutual funds. Personally, I prefer funds that prioritize risk management, as a strong downside capture ratio reflects better risk control, which is a critical factor in long-term wealth creation. Till now we've covered topics like direct plans versus regular plans, fund longevity, beta, alpha, standard deviation, Sharpe ratio, expense ratio, and capture ratio. In addition to these, other ratios like trainer's ratio, information ratio, Sortino ratio, and sector breakdown should also be considered. It's equally important to understand the fund's objectives and ensure they align with your financial goals. If you found this video helpful, don't forget to like, comment, and subscribe to Unbox Finance. Let me know if there's a mutual fund or stock you'd like me to analyze next.